Andy, last you and I spoke, you were talking about liquidity problems in treasuries. Does the Fed's action here support the market now?
Absolutely, no question about it. The Fed's action yesterday, with all the liquidity that they put into the markets with repos and buying of treasuries and now buying of mortgages, as well as allowing banks to drop off the reserve ratio for deposits they have, this will absolutely help. Has it helped yet? No. I mean, this is going to take some time. There's trillions and trillions of dislocation in the Treasury market right now. But to get to something your last guest, I guess Kevin, just said, I agree with most of what he said, except the idea of why the Fed moved. The Fed didn't move because they're looking at an increase in cases. The Fed aren't doctors. The Fed moved because they're looking at a closure of the U.S. economy. I mean, the whole Northeast is effectively closed. The West Coast is getting closed. I mean, I look at things around me in Austin, and people are closing up, reduced hours, and I wouldn't be surprised if restaurants close. The economy is going to plummet. All right, we're going to have GDP of minus double digits. Just look at China's numbers today. They were expecting retail sales to be down 4%. They were down 20.5%. The industrial production, the backbone of an economy, was down 13.5%. I don't remember what the prediction was. So you know what? These things are sending economies in free fall. I mean, you're seeing it all through Europe, and now you're going to see it in the U.S. And you know, as far as what the Fed can do and what the Fed can't do, look at what the European Central Bank. And the last 3 days, they announced an increase in stuff they're going to buy. In other words, additional quantitative easing. And the Spanish 10-year went from 24 basis points to 76 basis points. 3 days. You know, Italian rates, which Italy's always been a basket case, but they were down around 92. Now they're 192. Yeah. Greek rates, which had been at 90 basis points, are now 230. So you know what? It doesn't mean just because the Fed's in that the long end of the world's yield curves are going to do better. And what have we seen in the 10-year? Yeah, sure, we were at 96 on the close on Friday. We opened at 62. Now we're back to 76. You know, I look at the long bond of 138. You know, all I'm thinking is, like, the markets are sending, whether it's gold down 4%, which you just said, and oil down either side of 10%, and the S&P futures down, looks like close to 11% now. You know, what they're sending is a message to Washington that you have to do fiscal stimulus now. And I got to tell you, Oliver, I've never seen a better opportunity for the U.S. government to issue $1 trillion of 40 years at 1.5% or 1.75% or whatever it is, and fund infrastructure for the next decade. And you know, and then all of a sudden you have people looking at the economy 6 months from now and not 6 weeks from now, because 6 weeks from now it's going to be ugly, really ugly.